Hi, everybody. Welcome to our webinar. Thanks for joining us this afternoon. We're delighted to be talking to you all today. The topic that we've decided to discuss today is on why markets crash and what you can learn from this. And we think this is obviously a very topical item to discuss right now because obviously we're going through a period of great uncertainty and a period where we're dealing with a unprecedented event that's occurred that's triggered a market crash. So we hope this session will help you walk away with some knowledge during these uncertain times that you can apply to managing your own portfolio, not just to get through this COVID related crash, but to deal with any crashes that come in the future. So I am Sahil Bhargav, by the way, CEO of Barroso Club. And with that, why don't we get started? I'm just going to tee up the presentation on a screen share, and then we'll get started with the item for today. Okay, so hopefully you can all see the screen share. If not, please someone let me know. Okay, so I'm just going to turn on my pointer so that I can call out things on the presentation for everyone. Okay. So before we get started with the topic, I just wanted to introduce Barossa Club for anyone that's not familiar with us. We are a club that was started that believes that the key to delivering better financial outcomes for our members is to impart understanding of finance. We feel like finance is overly complicated in how it's explained to people, and as a result, they can't make decisions that are the best for their own situations. And so Barossa Club is targeted at explaining how finance works in ways that everyone can understand. And it's really started by two people, essentially, myself, Sahil, and Sanjay Bhargav, who's also on the call. He may jump in during the Q&A if there are any questions that he can answer. But essentially, both of our backgrounds are, we are financial services veterans who have worked our entire careers in financial services. So I've worked primarily in investing. So I worked in the US in both public markets investing at a hedge fund, where I did fundamental strategies in the equity markets, both long and short. And I also worked in private equity. So that's in the private markets, where I invested in taking companies private in the US. And now I'm excited to be running Barossa Club to help spread financial literacy in India. Sanjay Bhargav, who's the other key person in Barossa Club, he's had a long career at Citigroup in India, Thailand, and New York. And he also then served as a founding team member of a company called PayPal, which was in the payment space. You may have heard of PayPal. It was a company that was founded by Elon Musk and Peter Thiel. And Sanjay played a very key role in the company. He's also a key part of our team and also focused on spreading financial literacy in India. Now, in terms of how you can learn a little bit more about us, we do have a small case of our own. It's called the Barossa Top 150. I've given a link here on the slide, which you can see here. And if you want to learn more about our small case, feel free to go to that link and check it out. We're huge fans of what small case is doing. We think it's really good for the investor, because it provides you a chance to get better returns than mutual funds, potentially if you pick the right managers, and at a fraction of the cost. So I think it's a really good asset class for everyone to have some exposure to. So we're really delighted to be partnering with Small Case in this web seminar and hopefully future web seminars also. So great. With that, I'm going to jump into our discussion. So what is the question we're exploring today? So if you look at the stock market over a very long period of time, there are a couple of interesting things that we can take out from this data. The first is, and here I'm taking the US stock market just because we have the longest history and data set here, for no other reason really. So if we look at the US stock price, so this is the Dow Jones Industrial Average, which is one of the indices. It's like the Nifty in the US. And if we look at the data over long periods of time, we can see a couple of things. One is that market crashes happen pretty regularly. We run into periods where the market prices decline. But for the most part, markets recover And the extent that they recover is also very interesting. So you may have heard of the Great Depression in the late 1920s, early 1930s. This was considered to be one of the biggest market crashes uh, ever. And if we look at that period on the chart, I'm just circling it here. Hopefully you can see that. The Great Depression is barely recognizable on the chart with the benefit of time. So what does this tell us? This tells us that essentially, as time progresses, even what looks like huge market crashes look like nothing in the grand scheme of things. So this begs a question. If most crashes end up reverting back to price levels far above what we saw in the crash, why would anyone sell stock in a market crash? And if people don't sell stock, the prices wouldn't go down. But we know that people do sell stock. So why are they selling stock? Our job as investors are to buy at a low price and sell at a high price. That's when we do investing well. But we know, because prices go down in crashes, that people are doing the opposite. They are selling at low prices, and understanding why is something that we're going to explore in this session. And what you'll see is that there are really 5 forces that we identify that cause investors to sell at low prices. And when you understand these forces, you can better protect yourself from making these mistakes and then forcing yourself to sell at low prices. And that will be something that in the long run will help you generate greater investment returns and will also help you sleep soundly at night with greater peace. So that's kind of our goal in this presentation. And with that, let's take it on forward. So I'd like to start by just explaining what the fundamental cause of a crash is. Why do markets crash in the first place? So you can think of the market as a kind of betting system. When you buy a stock, you're basically making judgments about what you think the future earnings profile of the company will look like, or the asset that you're purchasing. And that involves making bets about the economy. Maybe I think that tourism is going to boom in India, so I want to buy ITC shares, right? So here I'm making a judgment about the future, right? Then something happens, right? Something happens that causes my bets to go bad. The unexpected happens. COVID hits. And suddenly betting on tourism increasing in India doesn't look like it's going to work out, because who's going to visit India when the international flights are canceled, when they're worried about contracting coronavirus, et cetera, et cetera. So suddenly something unexpected happens and people start to lose confidence in their bets. So the bets go bad. Now, what starts as a very localized problem. So with coronavirus, for example, you can think that the sectors that are immediately hit are restaurants, airlines, hotels, for example. And you may think, well, those are the only industries that will get hit by coronavirus. But then you have to remember that if those businesses are not doing well, people that work for those businesses are also not spending and they're losing their jobs. Or banks that have lent to those industries are also now in danger of having bad debts. So these bets that go bad trigger more bets in the economy to go bad. And this is what happens when we have a crash, where what starts off as a few bets going bad turns into more bets going bad. And then essentially that keeps trickling through the economy until we settle at a new equilibrium point. And when we've hit that new equilibrium point, the economy starts growing again. So that's kind of the dynamics of a crash. It's essentially something shocks us and causes our judgments of the future to change. And that's what we've experienced, obviously, in times like today. So how do bets spoil? Now, this is a very important slide to grasp in terms of why we see recoveries from crashes when markets recover, and why certain crashes we've not seen recoveries from. So some of you that are familiar with Japan, for example, in 1989, the Japanese stock market crashed at the end of 1989. The stock prices have still not recovered, and with now 30 years in the future from that point. So even 30 years after that crash, we're still sitting at below those stock prices. So what happens in those kind of crashes versus what happens in all the other crashes we've seen and discussed on that chart where you see recoveries? So there are really two ways bets can go wrong. So one is the bet is unrecoverable. So these are bets that are just plain wrong. These will go bust. Maybe you bet on a company that its balance sheet is not in good shape, and suddenly COVID hits and they're going to go bankrupt, right? So that's a bet that cannot recover. Then you have another type of bet that is bets that are simply delayed. So these are bets that are still intact. Basically, the thesis is still intact. Take longer for your bet to work. So let's say I invested in a hotel right now, but my hotel has lots of cash on hand and there's no risk it's going to go bankrupt. At some point, people will start using hotels again. I don't know how long it'll take. It'll certainly take longer for me to make money than I thought in the past. But at some point, that will restart. So these are bets that are simply delayed, and people will expect to see recoveries in these bets. So the difference between a Japan situation and a situation that characterized, the Great Recession, for example, most of the bets that went bad in the Great Recession were these second type of bets. Whereas in Japan, there was so much of an asset bubble created, and there was so much money going into sectors that couldn't support uh, that money, that they had lots of bets that were unrecoverable. And as a result, Japan is still reeling from crashes. Okay, so now I want to discuss something that we're going to really probe in here, which is that even if you have a crash that everyone expects to recover from, right? And I think most of us think that COVID is one of those cases where we will get through COVID and it's not going to fundamentally damage India's economy long term. It's just something that we have to work through, and the amount of time that it takes to work through that will dictate um, what happens in the future. But why are people selling, right? And this is what we're going to try and understand. And there are really five forces, as I discussed, that we're going to explore one by one. So let's start with the first force. So the first force I'm going to discuss is something called bankruptcy risk, or the risk of permanent impairment of your capital. So this means that, look, while a crash may delay some bets and uh, cause certain bets to become unrecoverable, you may just have made an unrecoverable bet, right? So if for whatever reason, as an investor, something happens where you suddenly lose faith in the investment you made, that it will not recover, then the fair value of your investment falls, right? Because you don't think this is a temporary issue for this company, you think it's a permanent issue for this company. So if an investor feels that way, they're going to sell even at low prices, because those low prices still may be higher than what they think the fair value of that business is. So there's a very famous example of this that just happened. I'm not sure if any of you saw the annual general meeting of Berkshire Hathaway. So Berkshire Hathaway is run by Warren Buffett, who is the greatest investor of all time. He is also one of the richest people in the world because of how long he's invested well over his career. Now, Warren Buffett said something very interesting at his latest annual general meeting. He had bought some airline stocks not too long ago, but he had the following to say in the meeting. I'm just going to read it out. The world has changed for airlines, and I don't know how it has changed, and I hope it corrects itself in a reasonably prompt way. I don't know whether Americans will have now changed their habits or will change their habits because of an extended period, if it happens, that we're semi shut down in the economy. And of course, the airline business has the problem that if the business comes back 70 to 80%, the aircrafts don't disappear. So what Warren Buffett was doing here is he was explaining why he sold his airline stocks. In Warren Buffett's view, something had permanently changed in his view of that investment. He was not sure that airlines would be able to operate back at 100% of the capacity that they were operating at before coronavirus. He thought that maybe habits had changed for a very long time for a lot of us. How likely are we to take another business trip? How likely are we to take a family vacation to a theme park? How long is it going to take for people to get that confidence back? So look, there's no crystal ball and there's no right answer to investing. But Warren Buffett made a judgment that he thought that it's going to take a very long time for this to happen. He may be wrong, he may be right. We don't know. But because he made that judgment, airlines were no longer a good investment for him. And at the prices he was seeing in that market, he had to sell his investment because it was above where he thought the fair value of those businesses were. So, in sum, one of the forces that can cause people to sell at much lower prices during a crash is if something has changed permanently about one of their investments. And if that's the case, they can sell it at even low prices and it still will be a rational thing for them to do. Okay, the second force that can cause an investor to sell at low prices is something called the asset liability mismatch. Now, this is something which we want to try and avoid as investors because basically in this scenario, you're going to sell a stock at a low price, not because something has permanently changed in your view of the company, but because you're forced to. And this causes a lot of missed returns on the part of investors. So I think this is one where you should really pay attention and try to avoid this for your own portfolio. So what does this mean? What does asset liability mismatch mean? So anyone that works in banking will be familiar with this because this is a key risk with banks and NBFCs. But in simple English, all this means is you're funding the purchase of stocks with money that you cannot leave in the market for very long. So let's work through some examples so we understand what I'm talking about here. So the first observation I want to start with is the observation that stocks are long-term assets. So obviously, if I have a rising market and prices are going up, it's easy for me to sell a stock at a price higher than I bought it and exit the stock tomorrow if I want to. But what if my markets are going down? Then I cannot rely on selling the stock to get a return on the stock, right? So then if I ask myself, how long do I have to wait before I recollect the amount I invested in my stock over time? How do we figure that out? Well, the PE ratio is a great way to do that, right? So let's look at this example. If I paid a P ratio of 20 times for a stock, that means that I paid a price for the stock of 20 times the amount of earnings it generates in 1 year. Now, if earnings did not change over time, right, which I know that stocks grow, but let's just say that earnings don't change, it would take me 20 years to recoup the amount I invested uh, through the earnings that the company generates. So I have to wait 20 years to get my money back if I don't sell the stock. Now, if I take some growth, let's say that earnings grow at 10% CAGR, it would take 12 years. So either way, we're talking about a long-term asset. Stocks are not something that we should invest in if you have a short-term time horizon. You have to be prepared to wait 10 years, etc., for returns if you're worried about crashes like this. So what happens? Why do investors make the mistakes of putting short-term money into the stock market? So during bull markets, investors get lulled into a false sense of security. Why is that? Because prices just tend to go up in a bull market, right? So we've had a long bull market, almost 10-year bull market, 11-year bull market, where stocks have just moved up besides little brief corrections that we've seen in the market. So people forget then that stocks can go down, and they're used to a situation where there's not much volatility in the market, and then they're afraid of missing out on returns, and then they tend to put money, even short-term money, into the stock market. So what happens then? They don't have the holding power to endure the recovery. So they need to monetize their short-term money in the event of a crash. So let's take a concrete example of this. So here's an example. The markets were good for years. So I thought they would keep being good. I started investing more and more of my savings in the stock market. Soon, 100% of my savings were in the stock market. Suddenly, COVID hit. I lost my job, and suddenly I needed money to pay my EMIs on my car, on my home, my son's tuition. So I was forced to sell stocks. It didn't matter what the price of the stocks were. All my savings were in the stock market, and so I had no choice. So that's how investing short-term money in the stock market can be risky. It's very important as investors that we keep enough cushion so that if we get into crashes, we have the holding power to wait through those crashes. The next force is borrowing money. And this is a special case of the second force, but I wanted to call it out as a separate thing because this is a very, very risky thing to do. And we generally recommend to our members that you never borrow to buy stocks. And a big reason for this is the same thing that when you borrow money, you're taking short-term money and you're putting it into a long-term asset. So let's explore this a little bit. So why does this happen? Because investors, again, they get used to rising prices and low volatility, and they begin to think that prices can't go down. Even very safe stocks, I'll borrow some money and put some money into a very safe stock and I'll be okay. But and why do they do this? Because borrowing can help them juice their returns. So if you lose leverage, you can increase your IRRs. But it can also magnify your downside risk. And so they become deluded on the safety of stocks, and it leads to increased rates of borrowing. So why is borrowing so dangerous? Well, borrowed money has a high opportunity cost. We all know that you have to pay interest on amounts you borrow. So your holding power is lesser because you have to pay interest on that money, right? And so if you wait, you're going to keep having to pay interest on stocks, on the amount you borrowed. Also, margin accounts are subject to margin calls. So if the value of a stock goes down, the broker may require you to sell stocks at a lower price. And so they dramatically lower your holding power and can force you to sell at a loss when you would have wanted to wait, right? So here's an example. Years and years of a bull market lulled me into thinking it was safe to borrow on margin. I used it to buy Reliance Industries stock. It's a very safe company, biggest company in India. What can go wrong, right? COVID happened. I didn't have the money to satisfy my margin call. My broker called in the loan, and I was forced to sell Reliance stock at a loss. Very quickly thereafter, the share price was trading back at record highs. So I was forced to sell my stock before the stock recovered. And that's the danger of using borrowed money to put in the stock market. We recommend at Barossa Club that you never, ever do this. It's okay if you miss out on a little bit of returns on the upswing. You want to avoid the risk of a catastrophic loss on the crashes. So we recommend that people stay away from borrowing to invest in the stock market. The fourth force is asset bubbles. So what does this mean? This basically means you paid too much for a stock. So why does this impact your ability to withstand a crash? So as we discussed, the PE ratio effectively measures your duration of your stock. So as the PE ratio grows, it means you have to wait a longer and longer period of time to collect your returns from earnings, right? If the stocks stop appreciating in value. So that means you're more sensitive to a shock. So let's take an example of this, right? So the most famous example of this is the internet bubble that happened in 2000. So how frothy can valuations get? So in March 2000, the PE ratio for the NASDAQ was 175 times earnings. That's an average stock on the NASDAQ, not just an Amazon or, I'm talking about average stock for the index was at 175 times. So even where bets were right but delayed, it took a lot of time to recover. So take Amazon, right? Even if an investor felt that Amazon was a good business at that time, right? And it was a good business, right? Look at where Amazon is today. It took Amazon 7 years to get back to the share price at the peak of the market. And if you didn't have holding power that was of that length and you had short-term money invested in Amazon, it would have taken you a very, very long time to wait for the share price to recover. And some investors cannot wait that long because they can't keep their money in the market for that long. And obviously, investors that did have the holding power, they made tons of money on Amazon regardless. If you waited on and kept your Amazon stock for 20 years, you would have done really, really well. So this is a great example of why you want to avoid paying too much for a stock. It means that when you get a crash, you're going to have to wait a longer time for that price to recover. Okay, so the fifth force is market timing and market psychology. So this is the worst of the five forces because this makes you sell even when you don't need to sell. Let's say that you didn't expect any insolvency risk in your company. You didn't expect it's going to go bankrupt. You think it's going to recover and you have the holding power. You don't need the money to sell, right? A lot of investors still sell. And they do this because of two reasons. One is the falling prices cause a panic and they can't see the price of their investment go down so much without feeling very scared and becoming emotional and selling. And the second is something else, which they believe they can call the bottom of the market. And in our view, calling the bottom of the market is almost impossible. There are too many factors that go into market timing to get it perfectly right. So we recommend for most people, if you have the holding power, do not try to time the market. Just keep your money. You may look at changing your mix of stocks or anything like that, but you don't need to exit the market if you have the holding power to stay in the market, as long as you feel confident this is a crash that we will recover from, right? If you feel like this is Japan in 1989, then you'll want to take your money out of the market. But if you feel like we're going to recover and there's no risk of insolvency, then take advantage of your holding power, keep your money in the market. So here, let's take an example of this. The market corrected 10% in one day, then another 5% the next day, and another 10% the following day. I saw my retirement account fall by lakhs. I got spooked, and as a result, I sold my shares on emotion. The market subsequently recovered, and I sold at a low price. So that's kind of what we want to avoid. So now let's get to the concrete recommendations and key takeaways for us. So what can we do as investors to protect our portfolios against crashes in the future? So we don't know when crashes are going to happen. If we knew that, everyone would be prepared for crashes, right? So you have to bake in insurance into your portfolio during the good times so that you can endure the crashes during the bad times. That's the key thing that we recommend to our members. And how do you do that, right? So the first suggestion that we have for most of our members is avoid bankruptcy and asset impairment risk. So that was our first force that causes people to sell. That's the fear that your bet has gone wrong. How do you avoid this? Well, one approach is you do lots of research on the stocks you hold. But to be honest, that requires a lot of time and a lot of understanding of how to evaluate balance sheets and individual companies. And we don't recommend this for most people because they're not suited to it. They don't have the experience in doing it, and or they don't have the time or interest in doing it. So for most people, what we recommend, a good way to to reduce the chances of this risk is to diversify. So don't invest in individual stocks. Invest in stock baskets. This is a big reason of why we're such a fan of small case. It's a very convenient way for retail investors to get exposure to a curated selection of stocks where someone has done the hard work for you. And now you trust their judgment and you're diversified so that if something goes wrong, it's going to be one stock out of 20, not one stock out of 5, right? Okay, now how do we avoid the second problem of asset liability mismatches, right? So that's putting short-term money in the market. Well, this is simple. You've got to keep discipline in our view and not put short-term money into the stock market, even when things are going up, because you're not going to know when a crash is going to come in all likelihood. And if you don't know that, you can get caught in a situation where you don't have enough savings to see you through a job loss or emergency procedure or any calamity that happens during a crash. So our advice for our members is only invest money in the stock market you are willing to part with for 10 plus years. The longer, the better. But 10 years is a good, safe time period because remember that if you take into account earnings growth and you invest at a 20 times PE, in about 10, 12 years, you get your money back through the earnings. So as long as you're willing to wait 10 years and your stock's going to perform at that kind of level, you will get your money back through the earnings growth. Okay, the third factor, borrowing money to invest. How do we avoid this? Simple. Don't borrow money to put it in the stock market, in our view. It's very, very risky. Wealth creation, in our view, is about patience and not get rich quick schemes. Fourth, asset bubbles. So how do we avoid asset bubbles? This is the trickiest one to avoid because the definition of an asset bubble is hysteria over something where we all think something is worth a certain price. And our recommendation for how to avoid asset bubbles is to keep asking questions about the market. What can go wrong, right? Is this a fair price? And the best way to do it is periodically look at the PE ratio of the market. If it's getting too high, you may want to cut back your exposures on equities. So a good rule of thumb for investors in Indian markets is that the average PE of the Nifty is around 20 when you look at it on a trailing basis over a longer period of time. If it gets a lot higher than 20, may want to think of reducing exposure to PE to equity. And if it's a lot lower, you may want to think of increasing exposure to equity, right? Very simple rule, but that'll help you watch out for asset bubbles. The fifth is market timing psychology. This is tough because it is natural to panic when you see the price of something fall as much as it did in late March. It's not easy to see the value of your investments go down. But really what you have to do when a market crash happens is to bring a clear head to the crash and say, okay, I'm going to look at my portfolio holistically, right? And using that clear, rational approach, you'll be able to make better decisions. Don't relinquish your holding power to the psychological forces that a crash can trigger in yourself. So I'm going to, last slide for today, before we open it up for Q&A, is I'm going to give you a little guide into the process that we use for evaluating what to do in a crash. Okay, the first step is understanding what's changed in the world. Clearly something has changed, right? That's why a crash is happening. Some facts were not expected that occurred, and I need to figure out what that means. So the first step is understand and figure out, are any of your investments permanently damaged? Like Warren Buffett did with his airlines, right? Doesn't mean he's right? Airlines could recover. Some people think they will, but he thinks they won't, right? So you should do the same thing with your portfolio. Crash happens, look at your investments, go through them, see, are there any of these that I think are at risk of permanently going bad? If so, exit those. Second thing, understand your holding power. Understand, do you have enough safety cushion for what you anticipate to happen to you personally? Let's say that you're working at a salaried job, right? And your salary gets cut in half because of COVID. Now your rent doesn't get cut in half, right? Your auto EMIs, you may have a moratorium, but the interest is still accruing, right? So those expenses don't go away. So your food bills don't go away. So you need to also think through, do you have enough cushion to see you through tough times? And if you don't, it's okay. You can always sell some stock or some of your investments to raise liquidity. But for future crashes, you want to manage your liquidity so you don't have to sell even when a crash happens. You've got access to money that's safe that you can use in the event of a crash. Okay, the third step is make sure you have the required holding power for your remaining investments. So once you've gone through this, whatever you've decided that you want to stay invested in, be prepared to keep that money in your investments, and you can obviously reallocate, but keep the money for a long period of time and make sure you can do it. Don't bank on a quick recovery, because if we look at these crashes historically, sometimes we see something called a bear market rally where the prices go up and then they go down even more. And the jury is still out on COVID, whether, market has now recovered some of this, but the jury is still out if the market's going to go down further from here or it's going to go up from here. So you want to prepare yourself conservatively to make sure that you have the holding power to withstand any volatility that will keep going. And the last step is keep up with information and repeatedly reassess. These are times of great uncertainty in these crashes. We still don't know what direction things are heading, right? So you need to keep updated with facts. And as facts change, keep looking at your portfolio and adjusting it accordingly. So with this, if you follow these guidelines, we think you're going to be able to sleep more soundly. And we think over a long period of time, you're going to be able to enjoy much greater returns and keep your stress levels and BP levels lower. And investing will become much more enjoyable for you versus a source of stress. And with that, I'm just going to walk you through a quick few things on Barossa Club. And if you liked what you heard, how you can follow us. So obviously we have a small case, which I've given you a link to. You can check that out to see if it's something you want to learn more about. We have a YouTube channel where we do more videos, which you can follow us to. You can find us at Barroso Club on YouTube and do a subscription there to stay in the loop of all our videos. And the last step is, if you want to learn more about our club membership, you can go to www.barossaclub.com. It was a lot of fun to do this session for you guys. I hope it was useful. I hope you learned something from it, and I would love to now go through the Q&A to see what questions you all had. So with that, I'm just going to stop the screen share, and hopefully you can all see me now. And I'll just open the questions, and then we will go through them. Okay. So I'm just going to go through these in the order that I have them. So AZ asked, present case, economy down, but stock market is up. Will this bubble eventually lead to a crash in coming months or year? So AZ, this is a very good question. And it's one that, frankly, no one can answer with 100% precision. One of the biggest rules in investing is that even the best investors are wrong 40% of the time. If you look at, I worked in hedge fund industry and private equity industry. If you looked at our track record of even the best in the industry, they were right only 60% of the time. Can you imagine that? Just slightly better than a coin flip. But that's enough in the investing world to gain an alpha. So please take this comment with a grain of salt. But in my view, when you look at the fundamentals stress that's happened in the economy, I think the stock market probably has gotten a little bit ahead of itself of the pain that's rippling through the economy. I think as I think about it, in my own personal investments and in our small case and in the advice that we give our members, we think that it's better to be cautious in this market because the risk of, for example, banking sector stress, right, we think is not being priced in properly in the market, in our view. But again, we could be wrong. But that raises a very important question. And AZ, I'm very happy that you're doubting the market, because as investors, we should always do that. The stock market should not be used as a gauge of how healthy the economy is at any given time. We should do our own independent thinking. How do we think the economy is going? Are my friends spending money? Did they lose jobs? How many of them do I know that are out of work or have taken salary cuts? And what does that mean for the economy? Are they going to be spending more or less, right? So as we think about what's happening in our circle, we can start making guesses and inferences about what's going to happen in the broader economy. So great question. Thanks for that. Okay, Palama P asked, can what happened in Japan happen in India? And if I have a SIP, should I stop or reduce or continue at times like this? So good question, Palama. What happened in Japan certainly could happen in India. It could happen anywhere in the world. And like I said, this is just one man's opinion here. But in my view, it is unlikely to happen in India because fundamentally in Japan, there was a massive asset bubble. So stock prices got so out of hand in terms of fundamental earnings that is not something you're seeing in India. In India, the average PE ratios did get a little elevated, but not to the level that they did in the Japan crisis. And also, India has a lot of demographic dividends that Japan doesn't. So, Japan has a declining population, an aging population. There are more people now retired in Japan than are working in Japan, right? So, it's become an upside down economy. India has the opposite. We have lots of young people and we have labor, therefore, and we have an engine that can restart the economy. But I do think that there is a risk, in my personal view, of a protracted economic recession for India. A lot of the growth that we saw from 2009 till today in India was driven by the expansion of credit to consumers. So all these NBFCs, for example, that came on the scene, right, were giving loans to people that were new to credit and allowing them to buy TVs and smartphones on EMI, Bajaj Finance, personal loans, etc. Right, and these loans allowed people to buy more, right, and that helped the economy grow. But now with COVID, one of the things that could happen is you could see that reverse a little bit, where lenders get a little more wary about lending money to consumers, and as a result, we may see a little bit lower growth for some time. So there may be a period where we see some economic damage working through the system. But I expect in the long run, as long as you're investing with a 10-year plus time horizon, in my opinion, I think we will emerge from this stronger than we entered into this. But you've got to be prepared to wait for a decade, right? Don't worry about um, where your money is based on today's stock prices. Because if you don't need that money for 10 years, it can sit in your investments, and once things recover, you can benefit. Um, so then you had a question on SIP. Should I stop or reduce or continue at times like this? I think, Palama, that a lot of that depends on how much of that SIP is long-term or short-term money. If you need that money for short-term needs, right? Let's say you had an income reduction in your job, then I would reduce my SIP to satisfy any holes in your safety cushion. If your safety cushion's in good shape, I would continue with your SIPs to the level that you're prepared to wait for the money to recover long term. Okay, and Nixon Fernandez, what about other who don't invest in a basket of stocks? So Nixon, thanks for the question. I would be very careful about not investing in a basket of stocks. If you have, in this crash, for example, if you have individual stocks and you're wondering what to do about them, my suggestion is, if you don't know a lot about these stocks and you don't have the time to research them, or you don't have the knowledge of how to do that, the best and safest approach is to sell those stocks and move that money into a basket of stocks. So I don't recommend that people hold stocks in times like this where they don't understand the balance sheet of these companies. Because if we face economic pain and damage, these companies that have bad balance sheets may not survive. Their stocks may go to zero, and no one wants to lose money like that. Sure, you may miss out on some gains, right? You may miss out on some gains if the stock happens to recover and all those things. But much more important to your financial health is preventing catastrophic loss. And don't worry about, did I leave some money on the table, whatever. You can move that money into a safer investment like a basket of stocks. Okay. Mutual funds seem much better for long-term holding and diversification, isn't it? So yes, I do think that mutual funds and small cases, right? Both are, a lot of small cases are also very diversified. So I think the concept of individual investors sticking to investment vehicles like mutual funds and like small cases is a very good idea. And you also want to make sure that your mutual fund or small case is not too concentrated on a specific industry. Let's say that BFSI is 40% of my small case, right? Or mutual fund or whatever. Then even though I'm diversified because I have many, many stocks, they're all concentrated in one industry. So you also want to check the concentration of industries also when you're investing for safety. Okay, where can I check Barossa Club small case? You can check the description below for our small case link. So I think small cases provided that to you. Otherwise, go to barossaclub.smallcase.com. Oh, sorry, I missed one question on that Palama had on what is a stock basket. So a stock basket is just basically a collection of stocks. It just means that instead of investing in one or two or three or four stocks, I'm investing in 15 stocks or 20 stocks. And why is this important? Because uh, um, if a mistake has happened, right, in one of these stocks, if I have only 3 or 4 stocks in my basket, then I can see a 33% or 25% hit to my portfolio. If I'm invested in 20 stocks, then it's only a 5% hit in my portfolio, right? So diversifying helps us spread our risk. Um, okay, so there are a lot of questions. I'm going to do my best for another maybe 10 minutes or so to tackle some of these questions, but we're not going to be able to answer all of them. If there are any unanswered questions, please feel free to email us at advisory@barossaclub.com. We will answer those questions for you as we go through them. Okay, has it ever happened that everyone was expecting a crash and it never came? Absolutely. People have been expecting a crash for a long time in this current market. A lot of people have been calling crashes even 2-3 years ago, and it took coronavirus for a crash actually to come. And most of the people that were expecting crashes did not expect coronavirus to happen. So I think the important takeaway here is not to try and market time. It's very hard to know when a crash is going to happen. Almost no one can do it. There are a few people that predicted the 2008 crash, but there are very, very few of them. So the important thing is to protect your portfolio at all times by acting sensibly and not taking too much risk by borrowing money, putting short-term money in the market. Okay. What are good sectors to invest in at this time? So a lot of this depends on your own opinion about where we are in terms of the economy. If you're like me and you believe that there is a risk of economic pain from this that's going to persist for some time, I would stick to lower risk areas, right? So things like FMCG stocks, liquor company stocks, or things like agricultural stocks where people are still going to eat, right? Even if incomes are down, they're still going to need to buy food. But if incomes are down, are they going to need to buy flat screen TVs, or are they going to need to buy smartphones, or all those things, right? So a lot of this depends on where you see the economy going. If you expect a very quick rebound, right, and people are going to get back to spending and salaries will come back and jobs will come back quickly, then you want to look at stocks that will benefit from that. So BFSI can be an area that will benefit from that, or restaurants or hotels, so ITC could be an interesting stock if you believe that's going to happen. So a lot of that depends on your worldview. Okay. So in a stock bucket, there is always a chance that you are not getting any returns, since 5 falls will equate 5 increases. Kindly explain. Good question, Madhavan. So you're right. When you're investing in a basket of stocks, really what goes into that basket is very important, right? It's not like magic that just picking 20 stocks and it'll all perform well. You actually have to pick the right stocks. So, our approach at Barossa Club is we look at momentum cues as well as fundamental research to decide what stocks go into our bucket. And we pick stocks that we think are going to outperform the market. And sometimes we're wrong, sometimes we're right. But hopefully more often you're right than you're wrong. And when that happens in your stock basket performs well. When it's wrong, your stock basket will perform badly. So, but the risk of a catastrophic disaster in a stock bucket is much less. So that's kind of why a stock bucket still makes sense, right? Okay, a question on what is the 1,000 rupees for Barossa Club website while signing up at your website? Yes, so the Barossa Club model, a few things I'll explain. So our fee for the small case is 1,000 rupees, flat fee, not AUM linked to anything. Our focus is to keep things low cost for our members. And we also have a club membership that someone's asking about, and that 1,000 rupee fee allows you to join the club. And joining the club, you get added to our WhatsApp groups, you get access to our tools that we have on our website, and you get access to our research papers. So we publish research papers every week and a half for our members based on our thoughts of the economy and our recommendations and all those things. So we've done papers on safe money, we've done papers on individual stocks that we like and how we look at them, what we think is going to happen to the economy, etc., etc. So you can look at that on the website. The membership fee is about 1,000 rupees. And then GST added on to that. Okay. Okay, so is it advisable to invest in index funds, small cases in SIP mode or lump sum during market dips? This was asked by Rohit Agarwal. So very good question. So see, clearly, if you can call the market dips, and the market dips happen frequently enough that you can time the market that way, it's better to do it through lump sums. The only issue I have with this, Rohit, is that it's unclear how often crashes happen, right? So people were calling, this is one of the longest bull markets in history that we've seen over this period. It was 11, 12-year bull market that we've seen. And people were calling, for a crash much before this. So the danger in waiting for a crash to do lump sum investing is you will just be waiting and missing out on returns. I think the safest approach, unless you're very clued in to the market, is to just do an SIP and just set it and forget it, and set it at an amount that you're willing to call long-term money. Then it doesn't matter. It doesn't matter. You invested right before a crash, it's okay. Holding power, right? You invested at the bottom of a crash, great. But that makes your life less stressful and less, and easier. Okay, so I'll take a few more questions. I think let's take maybe two more questions and then we'll end the session. And like I said, if you want to email us at advisory@Barossa, we can look at answering a few more questions that way. Let's see. I'm going to try and pick a question that I think a lot of people would have so that we cover a lot of them. Okay. Pritesh Jagtap asked a good question. How to identify if a stock is overpriced? So great question. We actually have a YouTube series that we call Stocks Zero to Hero on our YouTube channel, which walks you through how to do stock analysis for individual stocks. You can take a look at that. That'll give you a lot of insight in how to do it. But the short answer is you want to look at the price you're paying for that stock. And when I say price, I don't mean just the amount the share is trading at, but I mean the PE ratio, right? Because that's telling you how much you're paying relative to how much you're getting in earnings. And the PE ratio, you want to compare that to what you think the future looks like for a stock. So if the PE ratio is high, it doesn't automatically mean that the stock is expensive. So let me take an example of Avenue Supermarts. So this is the company DMart, right? So a lot of people look at DMart's PE ratio and it's over 100 times PE and they say, that stock's very expensive. And that may be right. It is a very high PE. But if you feel like DMart is a very, very good company, the risk in DMart is very low and it will grow quickly in the future, then even 100 times PE may not be that expensive depending on your assumptions. So you want to compare the price relative to what you think the future is going to look at. And it's hard to do. It's not easy to do individual stock analysis. But if you're interested in it, recommend you check out our YouTube series. It'll walk you through, and we take an actual stock. We look at Britannia and we did an analysis on how you would answer that very question in our YouTube videos. So I'll direct you there. Okay, last question. Let me find one that I think a lot of people would have. Um, okay, so here's one that's a good one. Abhishek asked, people choose a option trading strategy for high profits. So what is your opinion? I'm not a fan personally of option trading. Options are very high risk if you're doing them on an uncovered basis, meaning you don't actually hold the stock. So sometimes you can use options to limit your risk. Let's say that you feel very good about a stock you're holding, but you want to protect your downside, right? Then you can buy a put and have the ability to protect your downside, right? So in that circumstance, options make a lot of sense to me, right? The other way that people use options to make money in the market is they buy uncovered options. This to me is a very risky strategy, because if your option gets either your options in the money, in which case you'll make lots of money, right? Or your options out of the money, and in that case you'll lose everything. So generally my advice for people is don't try and get rich quickly in the stock market, because if you're doing that, you're probably taking a lot of risk, and the risk of getting financially wiped out is much more painful than missing out on some big returns and all these kind of things. Investing, in my opinion, is really about a tortoise versus hare approach in investing. And generally, the tortoise does better when you look at the data over a long time frame, over 15 years. A tortoise is almost always going to beat a hare. So I really recommend that people don't mess around too much with options unless they're using it to protect their portfolios. So great. With that, guys, I am delighted at the questions we got. I think they're really insightful. A lot of good thoughts in there for people. With that, I just want to thank you from everyone at Barossa Club that you joined the session, and I hope you got a lot out of it. And we look forward to doing more of these in the future for you guys. And it's delightful being on the Small Case platform. Huge thanks to Small Case and the team, Nikhil, Ati, for making this happen, and look forward to doing it in the future. Thanks so much. Bye-bye.